Hello, and welcome to Financial Clarity Live here on LinkedIn and joining us later on YouTube. Thanks to our friend Augie and team member here at Sustain CFO. Want to thank Phil and Augie for joining us today. So we're here to transform the way you think about your business finances. This isn't just a numbers game. It's about clarity. It's about strategy. It's about taking control. So over the next 30 minutes, we're going to demystify the financial planning process, show you why FP&A matters and how it can unlock your business's true potential. So together, we're going to cut through the noise, focus on what matters most, and arm you with the tools to make you smarter and make your decisions even sharper. So welcome. So Phil, looking at you today, this fortress that we see here, it's hard for small businesses to think about their business as a place of strength sometimes, especially if they're struggling to see what the future might look at like. So can you kind of take us through what that transformation looks like? Maybe think of a client that we've had where they started off looking backwards, rear view mirror, with their accounting not even clean, and then literally 3 6 months later after working with us, what that future might look like and why it provides confidence.
Sure. I think that's where we find a lot of our clients where they don't know where to start. I think this is from a fortress perspective. I always love your analogies. Never a lack for creativity here. But you got to have strong controls, right? So you got to have a good ledger and a good way of making sure that what you're doing is being accounted for properly. And a lot of the times, our clients won't have things set up, or they'll have them set up in a way that doesn't really give us a lot of granularity and good data to use to predict the future. So we'll start by assessing that, cleaning things up as necessary, working with the accounting team to get the ducks in a row so that way we can get some meaningful outputs on the back end. And then we build a strong cadence around financial reporting, closing the books, and then turning that into our rolling forecast process where we take the latest and greatest information and use that to drive actionable insights, compare where we're going, where we went, where we thought we were going to go, and all that good stuff.
Yeah, man. So you kind of helped us recap what we're about to do. We're gonna go over budgeting and forecasting. What's the difference? How do they work together? What happens if you're doing one well and one not at all? We're going to look at some of the tools and strategies that are used for success, both by our company and obviously plenty of others out there. We're going to talk about why scenario planning matters and how it can keep you leaning forward and on your toes when change occurs, which anyone in small business knows is constant and will happen. And then we'll hit a couple real world examples, talk about how that occurs, take a couple questions from the audience, and before you know it, we'll be out of time. Today we appreciate you joining us, and we're going to try to help you master budgeting and forecasting, just at least at a concept level, so you can understand how it as a tool and a strategy for your business can increase your ability to see what the future looks like. But let's start with the definition, um, or at least a concept of a definition. So, budgeting is a plan for managing your finances, setting limits for income and expenses. It's usually a relatively static process. It's been going on for probably thousands of years. If you go all the way back to like ancient Egypt, I don't know. This is just a made up fact. But when you think about forecasting, also a pretty ancient tool, right? Farmers used to use forecasting. They would literally sell the output of their farms before it would arise. And they were trying to predict basically future financial performance and consider a bunch of factors. In the case of farming, we're talking weather, climate, things like that. But in the case of business, Phil, when you pair these two things up, can you give us some simple way to kind of think about budgeting versus forecasting, how they fit together?
Yeah, I mean, so I think as you alluded to, a budget's usually a static thing, set for a variety of reasons, whether it's sales compensation, right? So you think about, you got a sales plan and that's kind of set at the beginning of the year and that doesn't change. And folks are compensated based on that once the year's over. So that was how I described it. That's a static view of the world. It's got its purpose. But forecast is more of a dynamic tool where you're constantly revisiting your assumptions and updating them and trying to reflect the most accurate picture of the future as possible at any point in time. So I always think about it. The simplest way to differentiate is a budget's a static view of the world, and a forecast is a more dynamic
Okay, fair enough. Um, a couple of different words thrown around. Zero based is this kind of starting from zero. Traditional will kind of use the past to be set, and then this rolling concept that you're talking about is where you're not waiting for a full year or a quarter to go by, but every single usually month, sometimes you can even get down to weekly, depending on how rapidly a business is growing. The forecast is being recasted, and the opportunity at hand. Obviously, there's some work involved, but if you have a team working with you, a finance team, it could be in-house, it could be an external fractional one like ours. What you're going to see from this is an ability to update your view of the future, to stop thinking and ruminating about all the scenarios that are going on, because you have one touch point, whether it be monthly, weekly, what have you, where you can bring new information, new assumptions to the table and get new outputs that can drive decision making. And then also, when it comes to that decision making, you have a place to do it. So I think a lot of folks think of finance meetings as like something boring and pulling up reports. It's kind of the point of the cycle where you actually have your hands on the wheel. Without that, you may be making those decisions in a silo, in a manner that is not transparent to your team, and that's pretty dangerous. So I guess as we look at the scenario side of this and you think about how we plan for this, Augie, you are one of the best, but let's talk about the worst. You deal with our clients all the time when things are changing for them. How are they using their worst case scenario? Let's talk about that first. How are they using that in their real world planning?
Well, a lot of times you'll have people who have had good success raising funds. And so they tend to look at, the theoretical without seeing it right in front of them clearly. They tend to look at an idea like maybe we're going to run out of money. And they say, oh, we'll go raise some more funds. But that is obviously not a sustainable solution for a business. So when they see it very clearly in that sort of worst case scenario outlook, it gets them to take another approach at how they're managing their cash.
Yeah, that brings up the conversation I think Phil and I had with one of our clients about 3.5 months ago. We had a financial operations meeting and a financial strategy meeting that was planned for every month. CEO was busy traveling around, making meetings happen, doing deals, and he had blown off a couple of these meetings in a row. And Phil had been working in an async manner as a CFO to get his attention. I had been helping on investor relations. We kind of called a timeout and said, "Hey, this situation isn't getting better. It's heading towards the worst case, and it feels like the decision making is just getting punted downstream." Short story long, long story short, we mobilized within, I think, 24 business hours, got to some very critical decision makings. And I can state, without mentioning names, we hit net operating income positive for the first time in more than a year this past month, December. So these worst case scenarios can sometimes jolt the owner, the decision maker, out of their either comfort level or just fear based paralysis to make new decisions. But Phil, I tend to be the optimistic one, entrepreneurial background. You tend to be the more accurate one, a little bit more conservative. Can you talk about best case scenarios and how those are used to drive the business forward?
Yeah, I guess the way I view these is it really depends on who your audience is, right? So, kind of piggyback on what you guys are saying, right? Your worst case scenario is really where you want to plan your cash. And to Augie's point, right? If you don't want to run out of cash, you manage your cash flow and you plan for the worst case. When it comes to the best case, that's where you're, communicating to potential investors. You're communicating to your internal sales team, right? You're gonna, in those particular audiences, you're gonna use a scenario that's more optimistic and more upbeat and more, all of these are within the realm of possibility. It's just a function of who the audience is and what you're trying to drive, right? So the best case is often used for a sales meeting or for an investor meeting where it's like, hey, if all the stars align and things go well, this is what's going to happen. We don't plan our cash on that, right? We plan our cash on if things don't go well, can we bulletproof our bottom line and make sure we can live to fight another day? So that's kind of how I juxtapose those two things.
I think that's very well said, and also, probably spreads a less rosier light on the fortress concept. It's not necessarily that you're just sitting on top, sleeping on a mattress full of cash. It's can we literally exist if all the things that we can visualize and the known knowns and known unknowns go wrong. And then there's probably something more in the middle, like a likely case. I guess, Augie, how do we use technology to simplify this forecasting process and keep it all straight and aligned so that it doesn't feel like too much? And matter of fact, hopefully it saves some time for our business owners out there.
We have a suite of really interesting cloud-based platforms like Giraffe, like Notion, like Just Consolidate, that do a lot of the heavy lifting in the more tedious elements. And so that lets us analyze things in a much swifter way. And the data is much closer to real time, and it's a lot easier to come up with an actionable plan in both directions.
Yeah, absolutely. And if your business has a sales or revenue model that includes something that's not as well known, right? There's a long lead time to close. This is where I think this becomes really important. If you have something where marketing turns into sales and that whole cycle is within 24 hours, it tends to be really important as well. But usually it's kind of about those mechanics of how things are converting as opposed to what's going to happen out of these potential scenarios. I guess, Phil, without being overly conservative, how do you help the clients think about, like, obviously we could prepare for a meteor strike and whatever your philosophical plan is to do in that situation, you would do. But how do you kind of gauge or set the parameter of what's likely but probably better case and what's likely but probably worser case? How do you frame that up for an entrepreneur that's out there listening and going, yeah, I'm trying to do this myself, I don't really have the money or the budget to put towards you guys currently, but let me think through this? Well, how would you frame that out?
Yeah, we do this day in and day out, and if you're going to be in the business of forecasting, you got to be prepared to be wrong. I say this to our clients all the time. I've been doing this a long time for big companies, and I never once walked into a forecast meeting and reviewed things and said, "Hey guys, everything happened the way we thought it was going to. Meeting's over. We'll connect next month." The purpose of the exercise isn't necessarily to be right or wrong, but it's ultimately to understand what are the drivers of the best case or worst case, right? It's ultimately, if you're in a business of selling widgets, how many did you sell, right? And whatever your estimate was, the more quickly that you can analyze how well you did versus what you thought you were going to do and why, and hold the right people accountable, that's the purpose of this process. So that way, going forward, the right people are in the right place, and knowing what management's expectation is and number of widgets we need to sell to break even, or the number of widgets we need to sell to meet the board's expectations, right? So it's really a function of having a process that's efficient so that you can get on top of these things as quickly as possible, communicating what needs to get communicated across the team, taking action based on what's happening relative to what we think is going to happen, right? Whether it's better or worse, it's really being able to do that diagnostic and then adjust our forecasting assumptions going forward, where whatever direction it is, and then that best case and worst case again resets itself. So it's a process, and I think that's the most important thing to remember, where you get better at it as you go along, and you're not necessarily always trying to be right, but rather trying to get some insights and be able to take action so that whatever is going right or wrong, you can either continue to capitalize on or pivot as necessary.
Yes, and I think a big component within finance, depending on who those audiences are, right, is about building trust, and that comes down to communication, timing of communication, and then narrative around that communication. So when we look at the finance goals, these look simple when you just bullet them out, but to actually think about the process of all the things that need to happen for the books to be clean, for the forecast to be rolled forward, for it to align with the strategic plan, and then to be measured with KPIs against the financial goals. This doesn't happen on accident. And what we found is, most organizations that are doing it really well are taking up about 85 or 90% of their month just to accomplish this. And so if anything's off, somebody's out of work on maternity leave, or somebody gets sick for a couple of weeks, or a vacation occurs and the handoff is not clean, you can very quickly get behind and then be in a perpetual state of struggling to communicate with those outside parties, the banks, the investors. And what we've seen is that has negative outcomes on the business's ability to grow and remain flexible. So, I think when you think about this, and we want to give somebody something to chew on coming out of this, I guess, Phil, how do you measure success in strategic forecasting? Like, how would you put that in a box?
Yeah, I think it's measured by a few things. The first being, is it a process that's efficient and you can repeat, and to the point you just made, right? It doesn't do you any good if you're constantly playing catch up and not able to, come up with your assumptions and be able to do this month in and month out in an efficient way. So, if you've accomplished that goal, you're well on your way. If the team's rallied around this and they understand what's going on, and that's the second component of this, where it's not just happening in a silo and the owner of the business is sitting there putting up a bunch of numbers on a piece of paper and no one knows what those goals are, right? So to the level that everyone's on the same page, if everyone knows what the year revenue goal is, and know what your profit margin should be, right? If everyone understands the targets for the company, that's another sign of success. So, I think those may be the two takeaways where, if you're doing this right, you're able to run the process efficiently, identify issues as they come up, and the right people own the responsibility and accountability to fix things, or to on the other side of the coin, right? Continue. They found something that works. They really continue to drive that home and to try to piggyback on what's working. So that's how I would view success. Right? It's not a matter of right and wrong. It's a matter of this process's ability to drive the business forward, make better decisions faster with more clarity.
Okay. And then, that's kind of how do you measure success? What if you were wrong, and what do you have in place in case you are wrong? I guess, Augie, what role do you see like contingency funds, contingency planning playing in the strategic forecasting process?
So like we touched on briefly earlier, you got to make sure the lights are on. You got to make sure that you're not going to run out of cash before your next big account comes through. So we look at sort of a blended view. A big part of forecasting is assumptions. And those assumptions are based off of past performance along with what you foresee coming down the pipeline. So in a scenario where maybe things aren't looking as great, those assumptions are themselves going to be smaller. They're gonna temper the forecast in both directions. And so when things are working better, those assumptions are going to be a little bit larger, and you'll see more of a potential for growth.
Got it. So it's kind of reading which way the wind's blowing and making sure that you're not trying to fight it or swim upstream. Like, if things are going against you, you might pivot into reserve mode, not make that next key hire, hold off on that next major inventory purchase, things like that, just to conserve cash and be in position for when things, revert back to the mean. Let's look for a couple real world examples. These ones are kind of, bullet points. Obviously, confetti and champagne at lunch is great. It doesn't happen often in the real world, but as we look at clients that are focusing on growth, let's think about that as a metric. I guess, Augie, can you pull out of your reserve of client stories without names or numbers attached to them, like, where did you see a forecasting process where, by planning for that growth, they were in position to actually go get it?
Definitely seen a handful of instances where people didn't realize necessarily the potential of a given income stream, and that there was really, if they shifted their focus just slightly, they could realize a lot more growth than they were originally even planning for. And so once you kind of have that on paper in a clean way to see all in front of you at once, you start to realize, oh, we didn't realize just how valuable these certain assets were, and maybe we should shift our focus slightly to take advantage of that recognition.
Yeah, absolutely. And kind of on the flip side, on the spending side, had a situation with a client, small business owner, sole entrepreneur. His wife works a job with a W-2. Unfortunately, was laid off, right? And we had been having conversations around spending, overspending. That they were resonating, but not necessarily leading to action. Immediately, within 24 hours of the unfortunate situation of feeling it at a personal level, the overspending stopped. It ceased. And we can already see it less than a month later in the forecasting process. So, whatever that catalyst is, whether it be the changing of the winds, a situation that if we're talking about how personal meets business, or just an overall, New Year's resolution to stop wasting money. Ultimately, if it doesn't create a return on investment, probably shouldn't be spent unless it somehow secures, like we're talking about the fortress here. So I'm going to keep us moving along. I got some questions coming in here live. So we've got Sarah, who is a e-commerce business owner and wants to know, how can I integrate forecasting into my daily operations without it becoming overwhelming? I think, Phil, she's looking at you for a little guidance.
Oh, well, the best thing to do is always find a little bit of help, right? Where, if it's not your forte, there's a good to know that there's folks around that, can help with these sorts of things. But I think the best place to start would be to keep it simple, right? This process I've seen can get to be, and for certain reasons may need to be very complicated, right? But I always start with kind of keeping it simple and kind of putting on a single piece of paper and just making sure that kind of take it one step at a time. So maybe not. We always look at this a lot, right? Maybe start with forecasting a full year as opposed to trying to figure out every single month, or forecast in a bucket of accounts as opposed to at every single account level and that sort of thing, right? So I think the best place to start, especially if you're just not you're really a big math person, would be to keep it simple, right? And ultimately, what you're trying to get at is what is the impact to your bottom line from the decisions you're making. So that's so long as you're working towards getting an answer to that, you're doing a good job.
Yeah, right. Just because there's a number that's showing up every day and it's moving up and down doesn't mean you need to be staring at it. I think I can't mention how many business owners that we've met, and they're pretty far in their journey, right? It's not first year, first two. It's like they're 5-10 years in, and I ask them, how are they measuring their financials, and they say, I'm looking at the bank account. Okay, how often? A couple times. A couple times of what? A couple times a day. It's like, there is no reason for you to be looking at your bank account a couple times a day. That is going to cause anxiety. I mean, I guess there are some reasons if you think fraud is occurring, but otherwise, like, just because it's moving doesn't mean you need to look at it. So Augie, can you give any tips on how maybe tools could be used to know that, hey, the process is occurring, and then I'm going to strategically get involved in this and allow for the process to play out?
Sure. Again, I always like to point out how important it is to have a robust and up-to-date tech stack.
Okay.
And that really helps you focus on the actionable points of information, as opposed to doing back of the envelope math to try to come up with a rough estimate. You have the hard data right in front of you, and that allows your brain to think about the actual how can you be actionable about that, rather than just trying to come up with the information in the first place.
Awesome. All right. Another question from the audience. This is Lisa. She's a leader of a health tech startup. How do I convince my team to take forecasting seriously? So, Phil, I'm going to kind of bracket this one. We had a recent conversation with some folks in a ramp up, raising some capital, got to a certain stage in due diligence with the VC group that they're courting, and realized that like they were unprepared to deliver the 5-year forecast that effectively their business model is based on, and that they are negotiating terms for exchanging equity for. So how do you get the team? It's that Stephen Covey quadrant 2 stuff. Like it's super important but never urgent. How do you get the team to take it seriously before it's too late?
I kind of always view that as, leadership starts at the top, right? So, I think it's something that the owner of the business needs to, make sure that they're, pushing that mentality down to their team. And I've always find, right, is, you hold people accountable to things, and you build their compensation based around, certain metrics, right? Especially bonuses and things like that. And all of a sudden, if their bottom lines gets impacted, people are super interested in what's going on, right? So I think it's, one with from a leadership perspective, making sure that, everyone knows who's responsible for what, and that month in, month out, they're going to get, they're going to make, you're going to be doing, we're doing these reviews and you're going to get asked questions. You better be able to answer them. So, I think that's kind of how I would view that is, take the process seriously, continue to work it, and make sure that folks are accountable for, the different components. And that way, it doesn't become just some, wishy-washy type of thing, but it becomes, real and foundational to, the daily operations of the business.
Okay, I've got another question from the audience. This one's interesting. I think for folks that deal with a lot of supply chain and goods, especially if they're from other countries, are thinking about the potential of tariffs and how they might impact their business. They've already sold a project, their revenue is already locked in, but they haven't acquired all the materials that are necessary. So this is Mike. He's a construction business owner. He wants to know what's the best way to prepare for unexpected cost surges in a volatile market. Phil, where's your magic wand?
Unexpected cost surges in a volatile market. Well, I mean, I think this really goes back to what we were discussing earlier, right? Where, you don't want to plan for you want to plan for a worst case and not necessarily a best case, right? And I get that you maybe don't know which one is which is what makes this tricky. But at the end of the day, right, if you're, you already know that you're in a business where things are very volatile, so you want to take a parsimonious approach to your forecasting assumptions, and not get too overly aggressive, because you know that things can and will change on you quickly. So I think that's how I would think
Yeah,
about
I
it.
mean, just to lay out a couple other ideas, right? It's like, what's your cash reserve look like? What does the clause in your contract look like regarding, unforeseen market conditions and your ability to change the cost if there's overruns, not because you did anything wrong, but because the prices on everything that you had priced everything and that change. And then, I'm an owner of an energy business and we acquire solar panels like years in advance of actually needing them. And we, took a hedge position as an example, because we knew tariffs might come and we have an excess of panels and we may have the ability to sell those off at a premium or, use them for projects downstream. And there's a storage cost to that. So it's not free. But it is a position. And I think taking a position is better than doing this. So keeping it moving, only a few minutes left. Here's the takeaways from forecasting to Fortress. Okay, so financial clarity, budgeting, forecasting, provide visibility. That's the purpose of it. It's not about perfection. It's about a process. Making proactive decisions based on informed choices is really the key here, right? So accurate financial insights will arise. They won't be perfect, but if you start making decisions based on making a stance on something and you're measuring it on a frequent cadence, you have the ability to adapt. And then, last but not least, we're talking resilience and growth. You got to be able to stay in business to be in business, and then you got to be able to hit growth when it occurs. I guess, Phil, Augie, looking for some last words. We'll start with you, Augie. What's your major takeaway that if you could just leave one nugget for the audience, you'd leave for them?
I would say, relating a little bit to the last question about unexpected cost surges, I say first and foremost to go through a detailed analysis of the last few years of historical data and find the unexpected surges that shouldn't be unexpected. For instance, seasonality might affect the business more than it really recognizes. It might recognize summer winter seasonality, but doesn't have a granular take on month to month or week over week.
Okay.
And once you go through that and you show some people things that were hidden in plain sight, essentially, it becomes a lot easier to detect that pattern in the future and catch things before they become a deep-seated issue.
Very good. All right. So looking ahead, forecasting ahead ourselves. Next week, we're going to be stepping into the world of KPIs, the metrics that matter most. So I want to go ahead at the top of the half an hour and thank you out there from LinkedIn for participating. Our guest, Phil Maffei, Augie Manzella, for supporting us here on Financial Clarity Live. Just a reminder, you can catch our weekly insights, financial tips, and Q&As from this episode on our newsletter, Finance in 5. You can find it at SustainCFO/newsletter. And we look forward to seeing you next week at Wednesday at 3 p.m. for our next episode of Financial Clarity Live, where we're going to be diving into KPIs and the metrics that matter most. Thank you, Phil. Thank you, Augie. And thank you, everyone out there. Have a great day.
Take care.